Hello and welcome to your weekly technical update, your guide to the charts that matter this week. I'm Andrew Gagan. Well, in the wake of the dramatic sell-off global equity markets have suffered over the past month, Jason McIntosh from Motion Trader gives us some historical perspective on the moves. This is how he saw the technical picture at the end of last week, just before investors moved back into the market to see some buying opportunities.
On average, the market has about, say 3, 5 to 10 pullbacks each year. And there's about a 10% correction thrown in every year or two. The ASX 200 is currently down a touch over 10%. So this currently isn't an extraordinary event. Now, I want to show you an interesting chart. I've got another chart of the ASX I want to show you. And this one's got an indicator on it. You can see that indicator below the market. So the indicator shows the percentage, the ASX 200 is below its 50-day moving average. And at the moment, it's about 6% below the 50-day moving average. Now, you'll see I've added a blue horizontal line at the lower end of the indicator, and that marks 6%. So when the indicator hits that blue horizontal line, it's 6% below the 50-day moving average. Now, run your eye along that indicator, and you'll see that it often marks an extreme. So yes, there have been some overshoots, and the COVID crash being the biggest overshoot, but I'm not quite sure we're in a COVID environment at the moment. Been a few other minor overshoots, but generally it's rare for the ASX 200 to get stretched more than 6% below the 50-day moving average. Now you can take this back a lot further. The same situation continues to play out back through the 2000s, the 90s, and so on. Now there are two types of sell-off that result in this condition. There's a capitulation, capitulation selling that often comes near the end of a multi-month correction, and that's certainly not the case at the moment.
Well, as investors began piling back into the market, Michael Gable from Fairmont Equities pointed out that usually when markets pull back by this amount, you do get some sort of recovery.
Over the next few weeks, I'd expect some sort of bounce from here. Now, whether that bounce gets sold into heavily and we retest these lows or even surpass them remains to be seen. But usually when markets pull back by this amount, you do get some sort of recovery. Now, it'd be interesting to see, of course, how strong that bounce is. So, the bigger the bounce, obviously the higher underlying strength there is there. So what I've identified are a couple of key levels where I think this bounce will start to slow down. So that's around 8,100 and 8,300 on our market. So if we start to hit resistance around 8,100 and really struggle, that won't be a great sign. I'd like to see our market at least get to about 8,300 before it slows down a bit, and that could indicate that the recent low is a major low, and just like in August last year, we may end up to new highs. But look, it's only the first day up or second day up after that pullback. So yeah, 8,100, 8,300, that's the zone where I think.
Stock specifically, Michael Gable digs into the resources sector for analysis of copper miner Sandfire Resources as the underlying commodity price rises amid speculation of Donald Trump expanding his tariff regime to include the red metal.
I was having a look at some copper charts on the weekend. Long-term charts look quite bullish, and Sandfire has been trending higher for a while now. This chart goes back a little over a year. Just nice profile where we could see it rallies quite strongly, then it consolidates. That's what I'm indicating by the blue lines there. We had an upside break in September, gave us another consolidation, and then it broke higher again several weeks ago. So it hasn't got too far from the breakout, so I'd say even current levels is still a buying opportunity.
And that's it for this week's edition of The Charts. To watch, join us for more technical talk next week. Happy trading.